Hey, good evening, everyone. Marty Mazzora here. It is the 6th of January, 2023, Friday, with your economic update and a brief technical analysis of the S&P 500 as well. In front of you is our PWA index, tracks 45 economic data points, scoring a minus 36 right here, folks. That is a very, very weak score and denotes notably higher recession risk going forward versus continued expansion risk. Our view still is that it'll be a mild recession and that it'll likely occur sometime during the first half of next year. How long it lasts, of course, remains to be seen. All of it remains to be seen, of course. And that's all subject to change as the data continue to come in. But right now, we think that a recession this year is going to be very hard to avoid for the U.S. economy. Looking at the handful of inputs that I want to share with you this week. So non-farm payrolls were a little better than anticipated. The prior 2 months were actually revised lower, so you can almost call it a break even. Now, yesterday when I was talking to Nick, we were doing our morning, market session, if you will. I talked about the jobs number today, and I also talked about the ISM services survey results that were coming out this morning as well. And my comment to him was that if the job market is strong or stronger than expected, and I think more critically tomorrow, which of course is today, the services ISM PMI results, if those are hot, and I think they're going to be, because for all appearances are that people are still spending a lot of money on services, then I think the market's going to have a rough day tomorrow. And again, this was the conversation we had yesterday. However, if I'm wrong and the jobs number is light, and especially if the services PMI comes in light, the market is going to scream higher for a day. Well, the jobs number came in okay, and the market moved up. The S&P was up maybe 0.5%, not necessarily a huge rally, but it was up. It wasn't lower, even though the headline number beat expectations. And the reason it was okay, frankly, is that hourly wages slowed in terms of the pace of increase greater than expected, and the average hourly work week came off the boil quite a bit as well. And when we're talking about inflation and the market's trading on the prospects for the Fed to continue to raise interest rates or not, it's really that wage data that's going to hold sway. And it definitely did. So we had a market that was moving up and down, up, then almost break even, anywhere between 40 basis points and 80 basis points, 0.4 to 0.8%. But when the ISM services PMI came out, and I'll show you that here in a second, and it was way lower, actually in recession territory, the market just ramped up. Interesting dynamics, isn't it? I'm talking about a weaker economy, and here the stock market is roaring in anticipation of it. And that is quite the conundrum, and that is not the best setup, and I'll tell you why when we get to the market dynamics here in a few minutes. So in terms of the employment numbers, again, pretty strong. Actually, the unemployment rate actually dropped to 3.5%. The household survey showed something like 700,000 new jobs. They were virtually all part-time jobs, from what I understand. The U6 unemployment rate, which includes part-time workers and discouraged workers, dropped to 6.5, and that's like as low as it's been since like 1994, if I read that correctly. Labor force participation rate ticked up a little bit. Job openings came out this week as well. They ticked down barely, but not what was expected. Still 10.4 million job openings out there, nearly twice as many job openings as there are unemployed folks looking for jobs. So that's a tight labor market still by definition. Quits rate actually went up a little bit. A higher quits rate says decent things about the economy because people don't quit unless they have something better in the offing. So again, if you X'd out the earnings and work week numbers, this probably would have been a pretty negative print for the stock market. The market loved it. Why? Because inflation's coming off the boil, and the Fed is going to, slow down or stop their interest rate hikes and maybe even cut rates. And again, we'll get more into that when we get into the stock market here in a minute. Now, initial jobless claims also show a strong labor market. They dropped to 204. That's like 20,000 less than expected. We are talking the holiday season, so put that into perspective. But again, that's a good look for the economy. Typically, you get nervous when you see hikes. It's not long historically after the trend changes and jobless claims start rising before we typically get into recession, these red shaded areas. It's hard to tell the way this is scaled, but there was actually a drop in continuing claims as well. So this is something that, of course, flies in the face of our recession thesis, at least for now. Okay, so I mentioned the ISMs, both the manufacturing and the services came out this week. I think I spent enough time on the written blog on Wednesday's report, the manufacturing report. This is the one that blew me away. Actually, the expectation was between 54 and 56. Below 50 says recessionary conditions. It actually came in at 49. And input costs to the services sector were actually down as well. So the market really celebrated that, right? Because it said weak economy, inflation coming off the boil. The Fed's going to be accommodative before the end of 2023, despite what they say they're going to be doing. As recently as the December meeting minutes, that unanimously they say no rate cuts in 2023. As I wrote this morning, I get it. But I sympathize with the market that the Fed will pivot in 2023. However, as I wrote in this morning's note, and I had misperception in the title, I think I did title it Market Misperception. I was just quoting misperception from the Fed's minutes, which said the market's getting it wrong. Remember, in mid-December, the market had rallied strongly in both October and November. And essentially what the members of the Federal Open Market Committee said is that the markets are not believing us, essentially. They're misperceiving where we're going with this, is essentially what they were saying. And if, for example, what is still a tight labor market, which appears to be their focus, remains their focus, well, then they're not easing based on what we saw today. And so the market may be getting ahead of itself. And that makes for somewhat of a dangerous scenario. And I keep coming back to the market, and there's more to come on that. I'll try to shut up on that until I get to the stock charts here in a second. Heavy truck sales look like they're falling off a cliff, and these are pretty good recession indicators historically when it really rolls over. We had kind of a scare there in 2016 that didn't turn into a recession, had it here. So we'll see. We think it's going to this time. Global PMI, Purchasing Managers Index, actually got a little bit better, but 48.2 is still very much in contraction or recession territory. Commodities in the aggregate using our Bloomberg Commodity Index, rolling over here. This looks like a nice, big, ginormous bull flag. We are bullish commodities longer term, but here they are rolling over. Good news for inflation. However, when we look at copper by itself, we have copper actually continuing to rally here, closing today at 83.63, call it. And you can credit China. They are aggressively reopening their economy, abandoning zero COVID. A lot of COVID cases, of course, as a result. But it seems like every day they introduce new reopening measures and new stimulus measures. Last night, with regard to their property market as well, which has been a real source of economic stress for China. So clearly, they are committed to making 2023 special for the Chinese economy. I'm not bearish Chinese stocks this year, as you might imagine, and to the extent that China traditionally does stimulate, it typically involves infrastructure spending, construction, and lots of copper utilization. And last but not least, the staples to discretionary stock ratio. When this is rising, consumer staple stocks, the stocks of companies that make the things we need to buy if we want to stay alive, to put it frankly, versus discretionary stocks, the stocks of companies that make stuff that we buy when we have extra income. When staples are notably outperforming discretionary stocks like they have been of late, that's a market indication that the economy is not in good shape, frankly. Okay, so there you have it. It's a bearish picture for the economy. It's pretty much what we've been signaling. It's a trend that we expected as our indicators began to unfold and our trend was developing in our own index. Anything's possible. We could entertain the idea, as obviously the bulls are, that the Fed will just say data-focused X financial markets, if you will, X the stock market, and go ahead and begin loosening if inflation continues to decline and gets closer to their target or accelerates toward their target. We do think that inflation is going to continue to decline. We think the Fed thinks so as well, but they are still uber concerned with stopping too soon and having inflation ramp right back up on them. I think they are concerned with overdoing it. We are seeing some softer language from folks who were very hawkish like Bullard here this week. But nevertheless, if the stock market wants to rally against relatively good jobs data, I think we run the risk of the Fed coming in and really talking things right back down. So we'll see. We'll know that here over the next few days and weeks. Okay, so getting to the S&P 500. So, folks, we're bearish on call it a 6-month time horizon still. And the weekly and the monthly charts, we think, give us technical reasons to feel that way. Of course, our primary driver of our thesis is fundamental. But I have been saying that the shorter term charts, the hourly in particular, and let me just go ahead and start there, actually look pretty bullish. So a rally in January would not be out of the question. And as of yesterday, S&P was negative on the year. As of today, it's probably positive, 1.5% or so. So we had just a really bullish setup that I was illustrating for you here. It was this falling wedge pattern against really strong positive divergences in the MACD and the RSI, our momentum indicators. We started to break out of that, but then we just kind of died and continued to dance right on this very strong support that we've been identifying and pointing out that would probably be strong support right here at 1800. And then we just have been consolidating here. You'll see the same thing on the daily chart. And typically when you have these, it's just like a spring that's coiling up in there. When you break that, you're going to break it with some momentum, and it could carry you higher. If the jobs number was super strong and the services ISM survey was strong today, I think we would have broke really strong to the downside. The kind of day we had at the upside, I think we absolutely would have had it to the downside. Now, our experts in the options pit tell us that there's a lot of put options expiring here on January 20th. And those put options are hedged by the dealers. So they actually short stocks to protect their downside risk against the people who bought the puts from them. So as we've talked about multiple times over the last year or so, those are short positions that will get covered. So our folks who we pay to give us insight into the options market and how it's impacting overall market conditions, they're not that bearish either for January. Their case, though, is the fact that if the market can hold up, if there's not some news that strongly breaks this 3,800, because things can flip there and start accelerating lower in a hurry. If they hold up between that 38 and 3,900 as we get close to expiration, and then those puts are either expiring or abandoned, and those hedges get covered, that could be some real upside oomph for the market. And so what they're essentially saying is that there could be something that really flips that whole gamma situation, and we get something precipitous, but they're leaning positive. That's just another thing that we pay attention to. For me, if the technicals were bearish, I would be bearish short term, but the technicals have been on balance pretty bullish, as I just illustrated for you here. So perhaps we do get a pretty good January before it's all said and done. The Fed can squash that on Monday if they come out and say that the market is just not getting it right with these rallies on news that really isn't all that weak. So stay tuned. Right now, the technicals on the short-term basis look pretty compelling. It would not surprise me in the least if we came back up and tested that bear market trend line. And I'll show you that here on the daily chart. So here we are on the daily. Here's that consolidation. So it's been happening, just like I showed you on the hourly chart, right? Big up candle here today. That's that right there. The MACD, you can see from the histogram that momentum is improving to the upside. If you had a microscope here or magnifying glass, you'd see that the white line just ticked above the red line today. That's a buy signal, and it's best when it's below zero, as it is right here. This is a clear bullish divergence on the RSI, right? You have a flat consolidation here, but you have this sloping higher. This kind of maybe beginning to. So improving luck, we had here a descending triangle, but you had these divergences suggesting that it was going to bounce to the upside. The other thing I have to note is look at this yellow line. We've looked at this before. The 20-day moving average has been huge, technically speaking. And when you break it with momentum, look out below. When you break it above with momentum, look out above. And today we closed above that with some momentum. Failed a test of the 50-day moving average, but it was a huge day nevertheless. Next week, if we get more of the same, then we're going to go up there, and then we're going to run up against our bear market trend line. With enough momentum, we could overshoot that. I have pretty good conviction that that would ultimately fail before all said and done. And you have that 200-day moving average resistance as well. So if we shoot through that 3,900, that 4,000 is going to be a tough area to overcome. But, anything's possible. So we'll explore that possibility if and when we get there. Again, we have a market that is just flying right in the face of everything the Fed is saying. Market actors in the aggregate just really don't believe that the Fed means what they're saying, or don't believe or doesn't believe that the Fed is going to be able to hold out with a couple more rate hikes and then keeping rates high for all of 2023 against a recessionary backdrop. If the market continues to rally, there's this thing called reflexivity, could absolutely bring animal spirits back, and that would keep inflation elevated, keep the economy in decent shape, and keep the Fed very, very tight. And so what I think, basically, my spiel here at the moment is that if the market's going to continue to rally and provide support for the macro backdrop, you're not going to get the Fed pivot. The Fed pivot's going to come with a declining economy, declining inflation, of course, and a stock market that's taking its next leg down. And that next leg down would be the result of earnings in a recession coming in below what's currently priced into stocks. We do not believe that stocks are pricing in anything other than a soft landing when it's all said and done. So earnings are too optimistic, what Wall Street thinks is going to happen. So probabilities, we believe, point to some more pain the first half of the year, reaction to that, and then we get some momentum coming in as a lot of spending comes in, fiscal stimulus, China stimulus throughout the entire year, which has global implications. And we think ultimately inflation steadies and starts heading back up the second half of the year. Nothing like we had here, say, a year ago this time, or between now and a year ago. But something notably higher than the 2%. Is the Fed going to redo its target? They're really resisting that. I think they're going to almost have to. If they don't do it officially, they're going to do it in practice. I think they're going to have to accept a higher inflation regime going forward. And 3 to 5% inflation is not the end of the world. In fact, some would argue there's something good about that. And frankly, that 2% inflation target is the definition of random if you understand where they ultimately came up with that. There really isn't anything that's scientifically based or important about that 2% number. It's just something they committed to. I think it was the Bank of New Zealand or somebody who dreamed it up way back when, and we just followed suit for whatever reason, or some past Fed governor did. We are firmly committed to that notion that we are entering a labor-friendly regime, which essentially is populism, and that is an inflationary regime. It's what the data and our experience and our study of history dictates, which means that we want to be positioned for what we think the next bull market looks like. And we think it's going to look different than the last, and we're kind of excited about how we're positioned for that, quite frankly. But we absolutely have to stay nimble and somewhat defensive in the meantime. Folks, thank you as always for watching and listening. Hope you have a wonderful weekend. Be back next week. Take care. Bye-bye.